who are the players in the industrial world? Like, for example, like, is it like, do mom and pop shop owners own like 50% of the industrial? Is it mainly big REITs or big companies that own it now, or what would you say that ratio is? And yeah,
Yeah, it's the vast majority is the mom and pop type owners
really?
by far. Yeah, vast majority. So
Hi, everybody. Joseluiz Morales. Welcome back to the Morales Group Show. This is episode number 58. Today, we've got a very special guest. His name is Carlos Serra. He works for a local industrial real estate company here in Southern California. Quick fact, they're actually the largest industrial landfill development owner in the world. I think they've got a market cap of over $6 billion. Carlos can correct me if I'm wrong.
in
So I'm
Southern
excited.
California,
In
not in the
Southern
world.
Okay.
I wish it was globally, but unfortunately not. Southern California.
Okay, so in Southern California. So
Yeah.
essentially, Carlos today is going to be going over just what is industrial real estate and different things as it relates to the industrial, and then comparing it to some of the different asset classes. Before we get into the interview, though, I have to remind everybody, if you have not subscribed to the YouTube channel, please hit that subscribe button, hit the like button. It helps out the YouTube algorithm. And then if you could share it as possible, that would really help out our vision to kind of spread real estate education across the world. So welcome to the show, Carlos. How are you?
Thank you. I'm doing well. The weather's improved in Southern California. The last few days are pretty cold, so I'm excited to chat with you.
Yeah, I'm excited as well, too. It's funny as we talk about weather, what is bad for us is nothing comparison to some of the other parts in the country. So
It's true.
essentially, we're truly blessed down here. So let's start off by, who is Carlos, and just tell us a little bit about your background as it relates to real estate investing.
Yeah, good question. So my name probably suggests that I'm Mexican or I'm Spanish, but my accent suggests something otherwise, right? So probably people are like wondering if
Yeah.
I'm South African or Australian or British, but it's actually the last one. It's a British accent, which is interesting because when I lived in multiple countries, and I was originally born in Spain, in the south of Spain, and my family's from Tarragona, which is just outside Barcelona. I don't know if you're familiar with it, but it's about an hour away from Barcelona. Hence the last name is Serra instead of Sierra. And yeah, my whole education though, growing up, was in the UK. And but I knew from a pretty early age I was going to move away from England. So I went through college, worked in London initially. 100% of my time has always been in real estate since 1998. So that's 22, 23 years of experience in real estate. And interestingly enough, how I ended up in it was back then in the late 90s, when we didn't have computers for everybody, right? Probably before your time. There was like a little program that you would input data on your likes and dislikes, and it came out with two options. One of those options for a career was a librarian, and then the other option was a quantity surveyor, which is not really a title that's used in the US, but it's about the closest thing as a sort of project manager, and it's kind of a hybrid. So that's actually what took me down the real estate path. I basically did not choose a librarian option. I actually hooked up with a friend of mine. One of his dads was this quantity surveyor project manager in the construction world. I spent a day with this guy, and I was just enamored with how you could have the ability to kind of run budgets and schedules and projects. And that was kind of what set me on the process. Probably when I was 16 years old. So I ended up doing a related degree, which included construction law, development economics, real estate economics actually, and design as well. So I did that. Then I moved to London, spent about 2 or 3 years in London working there, getting a ton of experience with some large scale architects on some ground up projects, primarily office as well, but there was also some historical projects as well, which are a little bit more prevalent in the UK. And then I got a phone call from a company. I'm not even too sure back then of how they found me, but they knew I could speak a little bit Spanish, and they said, look, we've got an opportunity. Do you want to come across to Madrid? Which I'd actually never been there before. and come and work for us. It was a satellite office of a British company, and they were doing a ton of different real estate projects, from commercial office to leisure centers, stadiums, pretty much everything. So I moved there and spent almost 3 years. And this was between 2000 to 2002. And it was an amazing time. And that was, around that time was also the first dot-com bubble that burst badly, and the economy turned. And just to give you an example of some of the strange kind of technology that was kicking around back at that point in time, one of our clients was a company called BT Genie, which was like an offshoot of a big telecom company in the UK. And their whole premise, I mean, it's funny to think about it now, but their whole premise, their business model was selling logos and ringtones for phones, right? So back when there were the black and white phones, the early Nokia and I guess the Motorola ones, right, the Razors and stuff, they would actually charge in Europe anyway. They would charge for the ringtones, whatever it was, like $1 or something, and they would charge if you wanted like a Mickey Mouse image or Fred Flintstone image or something as your screen on your phone. And literally those guys started, and then 12 months later they were out of business, right? Technology went really quickly, and we were working with a lot of companies like that, helping them with their real estate needs, and it just went from 100 miles an hour to zero really quickly. And that kind of then moved me to Toronto. So I kind of packed up and spent almost a decade in Toronto and a little bit in New York as well. And there I was covering pretty much most of the asset classes. It was actually for a real estate income fund. And we were involved in industrial, residential condos, which, in Toronto, New York, and Vancouver, they build them like I mean, there's no other place other than probably Dubai where they're obviously more prevalent as well. But and then retail, hotels as well, hotel condos. There was a lot of mixture. So that was kind of what took me on that path. And then about 10 years ago, I moved to LA and settled here to, kind of where I'm at right now. And that's kind of takes me up to 2021. But in the last decade, I worked for a couple of large Fortune 500 companies. I ran a local office, and I also ran a division, project management division, that was really helping a lot of real estate developers, big and small, for their needs. And again, that crossed all different asset classes. So I touched on, I know we're talking about industrial specifically today, but I kind of touched on industrial throughout my career over 20 odd years in different parts. And it was a little bit different depending on what angle, what vantage point you're looking at it from. So that's kind of the background that's sort of taken me to where I'm at now. And now I'm, one of the executives of a pretty large REIT, large as far as value. And we invest heavily in infill real estate, which is basically, it's not the kind of real estate that a lot of people think of in industrial, which is sort of the big 1 million square feet, 700,000 square feet logistics centers that you see in the Eastern Inland Empire. This is sort of typically smaller scale, relatively smaller scale square footage.
Okay.
Yeah.
So perfect. Okay. So for the viewers that don't know, we've titled it A Beginner's Guide to Investing in Industrial Real Estate. What is industrial real estate? Like, how can I spot a industrial development or an industrial building? Is it like a retail building? Are they located in certain parts of town? What is it? Let's start off with the very basics.
Yeah, so there's kind of a few definitions as to what would constitute an industrial building, and it's definitely changing in the last few years, even during COVID. I mean, for a lot of people, it's going to be manufacturing, storage, logistics, distribution, and warehousing. And I would say for this discussion, what we're probably talking about is not the manufacturing side, because for the most part, when you've got heavy manufacturing and true industrial buildings, they're typically owner occupied. Right, they're producing something and they're there long term, and it's a purpose-built facility with heavy equipment. I think what a lot of people are more interested in is a smaller scale, where it may be sort of e-commerce related, storage and distribution. That's typically what you would look at and constitute an industrial building. You mentioned retail, actually. I mean, from a construction perspective, there's actually a lot of similarities, right, in terms of what they look like, the size, etc. But industrial does come in a lot of shapes and sizes. I mean, it can be 10,000 square feet or less. It can be 1 million square feet. It can also be just a single user or it can be lots of users in those buildings. So if you kind of look at that cross section, you can have everything from a small unit that might be a CrossFit, dance studio, or you may have a FedEx or Amazon or somebody large scale to that extent, and then everything in between. And it's industrial is definitely changing because the supply chain has changed, right? During COVID, people have shifted from sort of bricks and mortar from the retail world into more e-commerce, into the industrial side. People are, even with the increase in ghost kitchens as well, you can kind of see how it's morphing and how it's changing. So there is that sort of traditional industrial that you would have seen outside of urban areas, typically in the middle of sort of less dense areas. But now it's starting to get more urban, right? And we can touch on it a little bit later, but you're also looking at probably the next generation of industrial, which will be multi-level industrial. And eventually I can imagine sort of the driverless vehicles going into those buildings, going in, driving up, and at different levels, and drones coming off them. I mean, that's probably going to be the next generation. In fact, that is the next generation. It's happening, even though people may not see it right now, but it will happen. And people are planning for that. And there's a few examples in the US actually where it is starting to happen. But people are going to shift, right? The level of patience from 3 weeks delivery to when Amazon came along to 2 days to 1 day to it's going to be 1 to 2 hours. And you are going to have that supply chain changing where they're going to want, you want to order something and you want it by 5 o'clock, right? That's for certain products that are lightweight that can be delivered in a different method. So that's the definition is definitely changing. The one item I would say that maybe I didn't touch on is probably the cold storage refrigeration as well, is another aspect of industrial as well. And that kind of is maybe a subsector of the industrial. And it's no different really to some of the other asset classes where you've got maybe residential. Within residential, you have condos, rentals, single family. It's the same sort of concept. There's sort of sub asset classes, for lack of a better term.
So essentially, I mean, it's a good niche to be involved in with all of the changes happening to e-commerce is basically what I hear you saying, that basically as all that continues to grow and develop, the industrial niche is growing as well too, and it's expanding with it, essentially is what I hear you saying. I wanted to ask you, like, the type of real estate that your company focuses on, it's not what I'm hearing, it's not the 10,000 Amazon building. It's more or less of a smaller type of units. And if so, what is the typical unit size as well too of like a typical development?
Yeah, I mean, I'd say the buildings, I mean, it's all relative, right? So the buildings are probably between 50,000 square feet to a few 100,000 square feet. And then if you look at the average tenant size, it may be between 10 to 20,000 square feet. There's of course smaller tenants, larger tenants. Some buildings will have one single tenant in it, and other buildings will have multiple tenants. It really depends on the submarket. So it's probably between that 50,000 square feet to 200,000 square feet sweet spot. But that said, I mean, certainly for some of the viewers that may be looking to get into that space, there's a big market below that in the smaller sort of square footage. It's probably an untapped market in some respects. And you mentioned about the e-commerce and the growth. I mean, definitely that's one factor, but I would probably argue as well that even in spite of COVID, the opportunities have been there for a long period of time, because between the port of LA and Long Beach, it's almost 50% of all port traffic in the US. So if you take the value of the industrial and the port traffic in Southern California, it's more than the next 4 or 5 markets combined.
Wow. That's big right there. Okay, awesome. So let me ask you this, because I mean, obviously you have experience in the other asset classes. I know that you own some residential. That's how we connected initially. Sounds like you've got multi-unit experience as well too, retail. What would you say the benefits of investing in industrial versus some of the other asset classes, or why would somebody want to get involved in industrial versus some of the other asset classes? And do you kind of see industrial as the cream of the crop, meaning like the best at, like if you had a choice between investing in any asset class, would you say that industrial would be the best asset class to invest in?
Yeah, that's a tough question to answer. I mean, I'm not too sure if one asset class is better than the other because it's cyclical. So during COVID, if you look at sort of the growth of asset classes and kind of which sectors have grown, it's primarily data centers and it's industrial, right? And that makes sense. I mean, people are relying more on technology. Data centers have needed to grow. And we've kind of seen that corresponding growth. If you look even at stock, right? What happened to Zoom during COVID and what happened to, let's say, Dave and Buster's on the sort of bricks and mortar, right? They've kind of gone opposite directions. So I don't know if the answer is necessarily which is better. I think it depends on the cycle. I think it also depends on your access to data, to brokers, to knowledge, right, of the particular market and financing. So to me, it's less about which is better. It's more about where the comfort level is and how much risk you're prepared to take. I mean, definitely industrial has some really strong fundamentals in Southern California because of the Port of LA and Long Beach. There's also millions of square feet that is owned by the sort of mom and pop shops where they've owned the asset for 10, 20, 30 years and they've invested very little into it. So it's kind of like the residential side where you've got somebody that's lived there for 20, 30 years and they move out and it's first time on the market, right? So there's a lot of that where you can go in and there's an opportunity to lift up that value and bring it up to market rates.
Perfect. Okay. And then are you guys majorly building most of the buildings, or are you guys buying them more or less from like just resale type of buildings, just out of curiosity?
It's mainly existing buildings, mainly existing. In the infill environment, you really, it's hard to build. Well, it's hard to build ground up anyway in Southern California, as you know, right? There's a lot of bureaucracy and it takes a lot of time with CEQA and entitlements. So we are definitely doing ground up developments, but there's also a ton of inherent value in the existing buildings where you can go in and some of those buildings are already stabilized and you can pick up a building that is more of a cash flow play. And there's also opportunities where you can go and you can invest a certain amount of money that you can invest into that particular building to bring it up to a market rent where maybe it's at 60 cents a square foot and you can get it up to 90 cents a square foot. And the play there is kind of understanding what you're going into, because there's definitely nuances in the industrial world that you do not see in the residential, let's say. There's definitely some differences that you have to look out for that maybe are not as obvious, if that makes sense.
So for example, like things to look out for, like I know when I'm looking at a residential property, I'm looking at the plumbing, I'm looking at the electrical, I'm looking at the foundation, I'm looking at the roof, I'm looking at obviously location. What would you say some of those nuances are in the industrial field that people should maybe somebody is not as experienced won't catch something like that?
Yeah, I mean, it's a good point. I mean, you mentioned some of them. I would definitely say that they're probably relevant to industrial and actually any asset class, whether it's location and competition as well. But I would say in the industrial side, you have to kind of understand when you're looking at urban infill industrial, the likely location of some of these buildings is probably less desirable, right? That's why they built the buildings in the first place there. So that leads to what are the issues in that particular neighborhood, aka crime, right? Could be one, homelessness could be another one. That issue that maybe people don't think about, but it could certainly deter potential prospective tenants coming into a building. And it doesn't matter how much you spend on that building, thinking conceptually that you can take it up to market rent. If there are other underlying factors that you could end up investing money to try and get it up to market rate, and there's factors that will prevent you from doing that. The other obvious one definitely is environmental. It's a huge one. So environmental normally will come through contamination, whether it's in the water or air or soil. And it's a tough one because contamination can come in different ways, right? It can come in the actual building, who's using that building when you potentially acquire it, but it can also come with surrounding buildings. And that could be either migration of contaminated water underground that happens to come under the subject property. That can actually come up through the slab and affect employees. But then you've also got air pollution as well. You may have a heavy industrial site 100 yards away, 200 yards away on the other side of the road that's actually contaminating the air and potentially puts you at risk. So that's a big one because it's maybe unlike residential where something on the environmental side, and particularly if you're talking about relatively smaller industrial buildings, it can be a disproportionately high cost. So you have to kind of go through those hoops of investigation very, very diligently. Otherwise, you could end up thinking that you're going to spend X amount of money, call it $500,000, and then you end up having a cost that's going to be 3 times that level of investment that was unexpected because there's additional investigations required. So environmental is a big one, definitely seismic as well. I mean, if you think about how these buildings are built, and the junction between the roof and the walls, right? I mean, in an earthquake, they can pretty easily collapse. So seismic bracing, which is typically done to secure the walls to the roof essentially and to reinforce that, is often done. And in fact, that also affects your insurance policy as well. So certain insurers will require certain standards as far as seismic upgrades. And then just other sort of risk really is downtime, right? So if you do have to buy a building, the downtime in terms of buying that building and potentially putting some investment into it to renovate it can be quite significant, right? It's probably a lot more than it is a lot more and a lot longer than the residential side. So strategically, you have to look at it that if you can pick up a building that has an existing tenant and you can position yourself so that you're getting everything done, permitting or your work sort of pre-positioned so that when they move out, you can start that work. That makes a lot more sense versus having an empty building for 6-12 months. So minimizing the impact from a cash flow standpoint is critical as well.
Okay, so just management and basically knowing how to run the operations, basically.
Right.
Essentially, important. Now, who are the players in the industrial world? Like, for example, like, is it like, do mom and pop shop owners own like 50% of the industrial? Is it mainly big REITs or big companies that own it now, or what would you say that ratio is? And
yeah, it's the vast majority is the mom and pop type owners by far. Yeah, vast majority. So the market is huge, and definitely there's a lot of inventory being built in the Inland Empire and other areas. But when we're talking about the smaller scale, primarily it's mom and pop type owners that really haven't invested that much at all. You can just, I mean, if you drive by some of these locations, you'll see that the landscaping is really not up to par, the paving. You're probably going to have some ADA issues, which is another risk. There's probably some environmental issues, roof issues where they patch the roof and you may have to go in and replace the roof and put a 12 or 20-year roof in place. So there's a lot of items where they haven't really invested, but it's good cash flow. And I think for a lot of prospective investors, you can come in and purchase sort of the smaller size industrial where it creates a capital event for those sellers. And you can go in and really have that opportunity to bump up the rents, right? But it does require, for the most part, requires some level of investment. And I think that's kind of the thing you have to watch out for. And I know you see it in the residential real estate, they refer to it as the pig in lipstick, where on flips, for example, they've gone in, you bought a house and you spent the minimum amount of money with cheap finishes, but it looks good, right? On the face value, and it's been staged really well, it's been marketed really well. But then you find out you got to change the boiler, or you got to change out the whole ductwork, and there's some bigger issues, or the roof has got some issues, and those are the bigger costs, right? That maybe are behind the walls, and it's kind of no different with industrial. That the costs are primarily what you can't see. So if you have a building, for example, with an electrical supply and infrastructure that is too low, then you may be going in there and finding out that you need to upgrade that to 2000 amps or whatever it may be. And there's a cost, right? So you have to kind of correlate what the market value is in terms of the rent that you can achieve, but also what you need to do to get it there. And that does require a little bit more thought, I would say, than the residential side, which is a bit more standardized. You kind of know what you need to do, and there's a lot more comps as well and access to information that you can gather from people like yourself that can educate people, right, in terms of what is it you need to do in terms of what the end value is if somebody's trying to do it as a flip.
If somebody wanted like education on something like this, are there coaches, are there mentors out there? Do they just look on YouTube, or what would you say that like if somebody wanted info on the industrial niche would be?
Yes, I would say there probably isn't, not that I know of. I mean, there's a ton of people in probably the office side and the residential side, right, that we know. The industrial side is kind of one of those odd outliers that people know about it. they know about e-commerce, but they haven't quite joined the dots. And we all utilize those buildings, right? We all probably have Amazon Prime, and we order from it all the time. So yeah, I don't know if there's necessarily many resources, and I wouldn't see that as a bad thing, though. I mean, in some respects, that's probably an opportunity, because sometimes when you're overwhelmed with resources, you're also looking at a saturated market.
Yeah.
And in our world, I would say that in the smaller scale industrial, you have a lot of family offices or small scale developers that are getting into it, and they may be, when you get into the bigger dollars, you're probably looking at cash purchases, significant dollars in the tens of millions. But in the smaller scale, less than $10 million, for example, you're probably looking at more the traditional path that you would see in the commercial office, where people maybe have an LP GP structure, and they're putting in some kind of debt, 60-70% debt on the property, on the acquisition, and they may be putting in 10-20% of their own equity and then pooling funds. I mean, that's I haven't seen it personally on the industrial side, because we're not working in that specific space, but definitely on other residential, multifamily, and commercial, that is very popular. It's a good way to kind of go from that single family to multifamily to maybe bigger investments, where you can pull together resources and get qualified investors. So
how would somebody finance like a commercial or industrial building? Is that like your typical bank? Or they specialty banks that only do industrial? What are the typical down payments? I don't know if you would know, because I would imagine that your company has additional resources. But like for your average person, like somebody like me, like let's say I wanted to buy my first industrial building, what would the finance look like?
Yeah, I don't know that. Yeah, I don't know the specific rates, but I would say when you get into sort of bigger projects, you're starting to look at the more sophisticated developers will go in all cash, because quite honestly, it's the only way to be competitive. In the smaller scale, I think you're still looking at sort of 60-70% leverage as far as debt that you can apply on that, and then the balance being equity. That's pretty standard.
Perfect. But then obviously we've competition, like somebody like your company. So essentially somebody like me is competing against large companies that own large industrial buildings, essentially. I've got a 30% down, and you guys are going in there cash. How do you underwrite an industrial building? Like I know, like for me on multifamily, I take the gross rents, I multiply it by 40%, expenses and all that, and then I do a cap rate after that. Are there any rules of thumbs when underwriting like a industrial building that maybe I can underwrite it in less than 2 minutes, whether it makes sense or not?
I can walk you through that. I mean, maybe just to address your first point, though, is generally speaking, I think when you were talking about competing against some of the larger developers, for the most part, it's institutional developers will generally compete against institutional developers, right? Small developers, family offices will compete against family offices. The larger guys, I mean, even us, we would not look at smaller deals, too small. So the larger guys will not look at it, because the costs as far as fees or legal fees, it's disproportionate. But if you're going into it as an investment to get into that asset class, there's definitely opportunities to get into it, and you're likely not to be competing against all the cash buyers in that sense. So it's just finding the right seller as well, right? I mean, it's like residential. It's relationship driven. It's typically not marketed. You probably want to be going off market or lightly marketed. So the strategy is a little bit different, and going after people that maybe they don't even know today that they want to sell, right? But so you kind of have to just position yourself and hustle the best way possible to get into it. But the other part of that equation is how much you're prepared to invest day one or day 100, right? Because that's another strategy you can use, is that there may be a level of investment that you want to put in that maybe the larger developers will look to do day one, right? It makes sense. They want to get it immediately to a Class A type grade building. But there's other ways you can kind of stagger that. And that means you reduce your costs, which in turn allows you to maybe to be more competitive and kind of offset what you're referring to as if you start to take on some debt. But as far as sort of basic underwriting for people that are looking to get into it, I mean, it is very similar. to other asset classes. Now, I know a lot of people will look at it maybe from IRR, equity multiplier, right? On the residential side, you look for certain IRR of maybe in the teens, right? High 15, 20%. And previously, it might have been even higher than that, and a multiplier in the high ones or maybe over 2 on your cash. But as far as a rule of thumb, I mean, you kind of have to firstly understand what your cost basis is going to be, right? How much is the cost of the building or the land, and then how much is the cost of those capital improvements that you're looking to put into that building, right? And that means what it's going to cost to renovate the space, any tenant inducements, which might be a couple of dollars square foot, and then plus leasing and commission, right? And when you put all that together, that's going to give you your overall cost base. The second part of the equation is trying to understand how much income you're going to get. Now, of course, that's specific to each market and submarket, but if you take a lot of the industrials around about $1 a square foot, 90 cents to $1 per square foot, I think 95 or something is the actual average in Southern California, which is a comparison in the other markets, Atlanta, New York, New Jersey, Chicago, it's about 60 cents or less per square foot. So there's a significant uplift in the SoCal market. But going back to the revenue side, if you take that $1 per square foot, for example, then you're going to have to look at how much of that is rentable. So there are little details where in some markets you can get rentable square footage on canopies over the loading areas, right? So even though it's not fully enclosed, if you've got a canopy over it in some markets, you can actually claim that as rentable square foot. So that can make a difference. But you take the dollars per square foot, the rental rate, over the square footage, that will give you sort of gross rent. So again, similar to the rental or commercial comparison. Then you're going to take the common area maintenance charges, part of that, how much you can recover from the tenants, because you obviously want them paying a portion of it, and that will actually depend on the type of lease that you put in place. Then you're going to adjust for vacancy, which may be 3, 5, 7%. You factor that in as well. And then there's also expenses that can't be recovered. And you know, the common area maintenance is an interesting one, right? That obviously covers some basic costs, but things like electrical, if you have multiple tenants, you're going to have to be careful about how you structure that, because some tenants may use a ton of electricity if they've got equipment just running 24/7. So a lot of sub-meters are installed so you can accommodate that, so you don't have a sort of disproportionate distribution across to all the tenants, and some people that have very low usage of electrical are getting dinged for that. So once you take all that out, so you've got your gross rent, take out your CAM charges for your recoveries, added to that, take out your expenses, and then deduct your vacancy, that brings you to sort of a net operating income. And then when you divide your net operating income to your revenue, that will give you a yield. So, you know, generally speaking, you're looking at something in single digits as a yield. It's not as high as some of the other asset classes, that's for sure. And that's probably why over time, people have not necessarily gone into that particular space. They're going into it now because of such high demand. But when there's high demand, it doesn't necessarily translate into high profit margins. Again, just like residential, high demand also means it's great to get into it, but the purchase price is that much higher. And so in industrial, you're talking about purchase prices higher, construction costs are still escalating at about 6 to 8% per year. And so, you know, the rental rates are going up as well. So proportionately, it's kind of like in a downturn market or upturn market, everything's kind of running in tandem, right? When there's a downturn market, there's less demand and there's oversupply and the prices start dropping, construction prices start dropping, but then the rates, the income starts dropping as well. During COVID was a little bit different though, because I would say the uniqueness of COVID put us in a position where all of those three factors were not quite in sync, because construction costs to some extent did not go up the same way. So rental rates are still going up, land prices, building prices going up, but construction costs were kind of flattening out. The reason why was because you had so many other contractors that were working in retail, office, that they don't have that much work now. So they're looking at other avenues to supplement their income, which is creating that sort of oversupply of contractors and design firms that are available to get into the sector. So you see a little bit of that as well. And I'm sure that it'll be similar to that scenario over the next 2 to 3 years, where there's no question building costs, a building that was maybe $5 million 12 months ago, now probably costs $7 million, right? But the rental rate that was maybe $1 a square foot 12 months ago is maybe $1.15 today.
Mm-hmm.
So yeah, exactly. It balances out. Like I say, the only uniqueness of COVID is that maybe the construction costs haven't gone up from X dollars per square foot and gone up by 8%. Maybe it's gone up a little bit lower. We did see that in the early stages of COVID, but then, I mean, without getting too granular, but then you did see commodity pricing change. So cement prices, because of COVID, that affected the supply chain. So the cement producers and suppliers were backed up. Their prices went up. Then we saw oil prices go up and lumber as well with the tariffs between Canada and the US and some of those strategies. So there's definitely sort of moving parts. And I think it goes back to sort of the fundamentals, right, of investing in real estate 101 is you have to do your homework. You have to do a ton of due diligence, and you have to test your assumptions many, many different ways, because otherwise you can be fixated on a particular property and convince yourself that that's the deal, right? And then you kind of talk yourself into the deal saying, you know, we're going to spend $100,000 on this. That's all we need to spend. And you kind of turn a blind eye to some of the blatantly obvious issues. So definitely doing your homework, because the rewards can be much higher, but then the risk on the other side can also be much higher as well.
Okay, perfect. And then is there a typical, do you guys use cap rates at all in the industrial world? And if so,
Yeah.
like what would a typical cap rate be in Southern California versus maybe somewhere else in the country?
Yeah, I mean, cap rates are not as low as sort of a multifamily Santa Monica deal. I've seen cap rates there. What are they? I don't even know what they're down to right now. Are they down to like 2, something ridiculous?
Yeah.
2% or something crazy. So they're a little bit higher than that, probably in the 5s and 6s.
Okay.
I mean, it actually is very, very dependent on the particular building type, but yeah, they're higher than residential. And that also makes sense, because if you look at kind of downtown LA, for example, and people have asked, why are we not building more sort of urban industrial or multi-level industrial? The reality is, and the arts district would be a good example, the highest and best use is not industrial, right? The highest and best use up until recently was a hotel or multifamily or mixed use. And so until that changes, I don't think the dynamics of the true sort of downtown LA or the urban market is going to change necessarily until some of the big players, logistics companies and e-commerce are willing to pay premiums, which will kind of balance that pendulum and move it away from a hotel or retail or mixed use. I mean, those sectors have definitely been hit right now, but I don't think anybody's jumping in too quickly to try and build some kind of multi-level. There's examples in Seattle and New York, but you're also dealing then with zoning changes and entitlement issues and just the longevity of trying to get through those, jump through those hoops. Yeah, so.
Awesome. And then what do the leases typically look like? Like I know that in commercial, there's a term called triple net lease. Is that typical in the industrial world, or who pays for?
Okay. Yeah, it's pretty typical with a triple net. So you're getting the tenants to pay. But lease terms can be all over the place. A lease term could be 90 days. A lease term could be 3 years, 5 years, 10 years, because that's definitely, I'm glad you brought that up, because that's definitely a big difference. Is that if you're looking at an office space, the logistics to move somebody into an office, commercial office, pretty high, right? I mean, you've got all the furniture, you've got the layouts, you've just got a lot. And that makes sense, because that's what the particular tenant is looking for. They're looking for a long-term space for their employees. That's not the case in industrial. In fact, people are not, I mean, they're interested in, of course, in square footage, but the difference is they're interested in volume, like cubic feet, right? They're looking at height. What is the clear height of that building? How much can I store up to? What's my racking? What's the sprinkler system? What can I put in there? What products can I put in there? Because there's a lot of determining factors in terms of what type of sprinkler system that you have in place will dictate how high you can go as far as racking space. So you may have 2 buildings that are 28 feet clear height, but the ability to rack and store is different depending on the sprinkler system. And if it's an older system, you won't be able to store as high. But the industrial tenants are more interested in the warehouse space, right? So on a 50,000 square foot building, let's say, approximately 5-10% of that will be office, but that's almost secondary, right? That's really not their primary focus. They're looking at space. So it isn't unusual for tenants potentially to come in and they can just put up temporary furniture, even in the warehouse space, and they just take the warehouse space because that's all they need. They need load-in, unloading. They need overhead doors. They need maybe dock-high load-in as well. And that's all they care about. So for some entities, they can come in and say, we'll take the space for 90 days. And they can be in and out, and it's and particularly on the e-commerce side. So it is a little bit different. And that does mean they can move in quickly, but guess what? That also means they can move out quickly as well, versus an office where you've got to demobilize a lot more. So yeah, it's kind of unique in that sense.
Okay. You said something earlier called, you said CAM charge. What is I didn't understand that part. Can you break that down for us?
Yeah, so the CAM charges are basically the common area maintenance charges, right? So some of this can include utilities, it can include security, certain costs you can basically push onto the tenants, and then depending on the use of the tenant, for example, on the electrical, you may not do that. You may submeter it so that each tenant pays their actual portion that they're using. So generally, you would push a certain amount of charges onto the tenants. That becomes additional revenue, and there's a certain number of expenses that you cannot recover, cannot recuperate, and that's obviously a cost.
Okay, perfect. And then, do you guys typically, or whenever you guys are looking at industrial buildings, are you guys typically looking for buildings that have under market rents with an opportunity to do a value add, or is it more or less just buildings that are already established? And what would you say to that?
Yeah, I'd say that it's the first option is a sweet spot, is always going to be value add, because the margins are limited, right? When you're going into something that somebody's already invested and it's stabilized, at the end of the day, if you're buying that, I mean, it's kind of like buying a flip, basically, right? You're paying someone's profit. They're looking to get a return on that flip, and industrial is no different. So absolutely, you're looking for buildings that are well under market value, that there's potential to uplift them and get that leasing spread and take it from 60 cents to 80 cents or 90 cents. But also, you're not looking at it the same way as some of the other sectors, because aesthetically, the solution or the aesthetics of the building are not really one of the primary drivers. It's going to be the functionality of the building. So as long as the roof and the basic mechanics of that building are secure, that's what people are looking for. And going back to my earlier comment, you're looking for that space, right, and the volume of what you can do, and make sure that building's secure, it's got the right height. It's not about sort of spending a ton of money on the office area or on the facade to make it look pretty and have that sort of that value, that drive-by value that people look at and get excited about. It's a different, you're looking at a different occupier and a different type of tenant. And if it's a CrossFit, let's say, or dance studio, I mean, they're really looking at something that is functional for them. It meets their purposes. It's got the right signage. It's got ADA compliance for access, wheelchair access, etc. And that's pretty much it. So you kind of have to look at it in that context, because again, you're talking about something that's $1 per square foot, a rentable space, versus office, which may be $3, $4, $5, $6, right? If you're in the West Side, Century City, you're looking at $6, $7 a square foot. So there's a big differential in that. And so your focus as a real estate investor is different, and you kind of have to use some of the rules of thumb or the things that maybe you've taken from residential or commercial office and adapt them a little bit to the industrial environment.
Yeah. What is the best way to find a tenant in the industrial world? And what would be, and I know obviously it would probably depend on the building, but what would you say compromises a majority of the tenant base, like mechanics? I know that you mentioned obviously dance studios recently.
Right.
Obviously there's gyms now. What would you say like the tenant base looks like, and what is an ideal tenant in the industrial world?
Ideal tenant is the one that pays. Yeah, it's a good question. I mean, I would say that there really isn't an ideal profile. I think it's just down to whatever the financials are of that company, and the probability that they're going to stay there for a while. And the ideal tenant is definitely someone that doesn't require a ton of TI work, that doesn't need to modify the building, that doesn't need specific power requirements for certain equipment. So something that's super light, whether it's just more for distribution, logistics, versus any type of manufacturing, I would say is probably the ideal tenant. And then also kind of taking into consideration if it is manufacturing, for example, versus distribution, the parking ratios can vary depending on the jurisdiction as well. You can start increasing that. And same way, if you've got a lot of more office space, for your office, depending on the ratio between office and the warehouse, the more office you have, the higher parking counts you need. And so that kind of, you run the risk there that depending on the particular tenant, if they need to expand or shrink that office, that could create potential issues. So I don't think there's necessarily an ideal tenant other than ones that I guess the minimum requirements they have, the better. And you kind of have to offset that based on how much they're willing to pay, because obviously the ones that are maybe needy, for lack of a better term, they're also probably more prepared to pay more and then probably be there for a longer period of time as well if they're investing their own money, because a lot of these guys will come in and some may invest their own money for racking and storage, and others may invest even more money for equipment that they're moving in there. And so those tenants will often stay a lot longer. And you also, to be honest, you also in that market, you may also be buying buildings that the tenant's already there, right? And the seller just wants to get out, and you kind of have to, you take on board an existing tenant. And so, you know, your exposure or your investment may just be the acquisition of the building, taking on the tenant, and maybe just putting some basic upgrades to maintain that tenant. And that's actually an ideal scenario because it buys you time. It allows you to kind of take the cash flow, invest over a period of time. You don't always have to, you can defer some of the maintenance items, and you can invest over a period of time. I mean, it's, when you look at it from a cash flow perspective, you're not having to do all the work in year one, right? You've got, maybe you don't have to touch the paving for 3 years or 6 years, or the roof you may not have to do until year 8. And that really, it depends on which bucket you're in as far as the investor type. If you're a 1 year turnaround, turn the building, the value add, like you mentioned before, you invest it, you kind of flip it and find
something larger,
a tenant that's willing to pay more, and move to something else. Or you may be sort of somewhere in the middle where it's sort of a 2 to 5 year play, and you're looking to kind of stabilize it, maybe refinance it and keep it there for a period and then move on. Or you just maybe a longer term where you're looking at more sort of cash flow, in which case, in that case, which is more so the longer term investors are sort of the larger developers, typically is more of a cash flow play. You are spending more money up front because you're going to put a 20-year roof or 12-year roof pretty quickly and early on in that process, versus kind of what we were talking about earlier, that how do you compete? Well, you may not choose to do all that in that time span that you're looking to own that property. If it's a 2-year or 3-year time span, you may, when you do the review of the building and you're bringing in a roofing guy to take a look at it, you may just determine that, this is a year 5 cost, and we're going to allow X amount of dollars for basic maintenance until then. And you're basically deferring that, and obviously deferring that until the next buyer, basically. So there's a lot of ways you can kind of slice and dice it.
Perfect, man. Good. I think we pretty much covered anything, Carlos. Is there anything else that we might have missed that you think would be important for the viewers?
I don't think so. I mean, I think we covered a lot. I mean, it's there's a lot of information there. I mean, if people want to reach out, I'm not on Instagram as much as you, but definitely on LinkedIn. If people want to reach out and send a message, happy to help, or they can send you a note as well and connect with yourself and chat to them. I mean, it's an interesting market. It's fun. I still have a big passion for single family residential as well as an investor, and but it's nice to kind of mix it up a little bit.
Yeah. For me, I mean, there was a lot of things that I didn't know about the industrial field, and essentially it was almost like getting my feet a little bit wet. Obviously, like, all I can envision during the interview was a couple of industrial buildings that I know in town, and just kind of
right.
was curious to kind of look at the numbers, like, okay, what do they buy it at? What are the expenses? How much money does it make? Because I would imagine I'm mainly in the multi-unit space, so I owned multi-units, and it's very management intensive. What I mean by that is that stuff breaks
Right.
and things happen, you know, and it's just a little bit more management intensive. Obviously, I love the vacancy. I mean, because there is no vacancies right now, at least for us on any of our buildings, so it's very high demand. So I wanted to say thank you, Carlos, for being on the show. I also wanted to remind the viewers out there, if you haven't subscribed to the button, or if you haven't hit the subscribe button, hit the subscribe button, like it, share it. It helps out the YouTube algorithm. Thanks again, Carlos, for being on the show. This was episode number 15. Carlos Serra, Beginner's Guide to Investing in Industrial. And then maybe we'll eventually do a part 2, something a little bit more advanced as I continue to learn more about this field. But thanks a lot.
We can vlog it. We can do a little tour and we'll vlog it live for people and walk around the building and see what we're looking at.
Oh, I would love that. Yeah, we'll have to connect with you on that. That would be
socially
awesome.
distanced, of course.
Yeah, great. It's great talking to you.
Thank you for having me. All right, take care.
Cool, man. It ended.